What is inheritance tax? We're following up from a webinar that Simon and myself did a few days ago with Ross from Hive, and we're just going to explore that in a bit more detail, talk about inheritance tax and things that we can do about it. So my name is David Abel. I'm an independent financial planner working for Vision Dental Wealth, and I'm joined by Simon, Head of Tax at Hive Group.
Thanks, David.
So I guess we'll start off with what is inheritance tax, if that's okay.
It's a good place to start, isn't it? So inheritance tax, for those who didn't watch the webinar, haven't seen it, it's, broadly speaking, it's the tax that we pay on our estates once we pass away. There's more to it than that. There can be some situations during a person's life that trigger inheritance tax, but it's kind of all about the value of the assets someone owns when they die, and the government getting their slice of that.
Which they always get.
Yeah.
Or in most cases they get anyway.
Well, if you don't do anything about it, they can get the biggest slice out of anybody.
Yeah, exactly.
Which we've seen with a case study that we looked at on the webinar.
Yeah, which is scary.
Yeah.
And I think it's useful to talk about some common misconceptions about inheritance tax and what maybe people don't understand properly, or they maybe don't even think about at all.
Yeah, I think the biggest one is that everybody has a nil rate band, so 325k worth of assets you can own before the government say, actually, we'd like a slice of that.
Yeah.
There's an additional residence nil rate band, an extra 175k, turning 325 into 500 per person, when your family home basically is being left to direct descendants, kids, grandchildren. That gets tapered away if your overall estate is above 2 million, and that's your estate before reliefs as well. So you could have a business which is exempt, which we'll talk about a bit more in a moment, but actually that's still eating up that £2 million worth of asset value.
Yeah.
And a lot of dentists, a lot of people watching this are probably going to have lost that.
Yeah. And it's something that they don't understand, and if they've done their own calculation, they've not factored that in, and obviously that has an impact on the amount of tax you pay.
Definitely.
Yeah. And again, I guess common misconceptions which we discussed on the webinar, business property relief, and then once you kind of sell your practice, what position that puts you in?
Yeah, definitely. So business property relief and similar relief that farmers have basically says, look, if you own a business, we don't really want to have to tear that apart to pay a bit of inheritance tax. That's where it originally came from.
Yeah.
Let's have there be no inheritance tax on the value of the business that your family owns and runs. That's recently been capped to £1 million per person, with unused allowances transferred between spouses like all the other allowances are. But actually it's not too much of a stretch for a business to be worth quite a bit more than that.
Yeah.
And the kind of the follow-on that a lot of people aren't really thinking about yet is that when you sell it, which is the natural path for a lot of dentists, you're taking a valuable asset that may have been exempt and turning it into cash or other investments that are definitely not exempt. So selling your practice immediately create a huge tax problem for a lot of people.
So from overnight, if you've got, let's say your practice is valued, or your shares in the practice are valued at £1 million and you sell it, and your estate is above the thresholds, overnight you've got a £400,000 inheritance tax issue.
On top of any tax you might have to pay from capital gains tax and all of that kind of stuff from selling the practice in the first place.
Yeah. And, well, that's quite scary.
It is,
to start with.
Really big numbers really quickly, aren't
they? And it's often overlooked.
Yeah.
I guess we'll talk about what you can do about that when we talk about more of the planning stuff.
Yeah.
But what other misconceptions do you think people often overlook or misunderstand?
One thing that a lot of people kind of say to us, and they'll come to us with this idea is, well, I'm just going to kind of get my dad to give me the house so that, he's quite elderly, parents will be old, get mum and dad to give me the house. I'll let them live in it, but hey, it's mine, so there won't be inheritance tax on that. And it sounds like a great idea.
Yeah.
Sounds like an obvious thing to do, but there is a whole set of rules. Basically, someone's already done that. The government's already stopped that.
Yeah.
So there's something called a gift with a reservation of benefit. If you've given away an asset, or if an individual has given away an asset, and they may genuinely legally have done that, but if they still get to enjoy or use that asset, i.e. still live in the home, it's still counted for inheritance tax. So a lot of people think that, haven't taken proper advice. Their family have started to kind of move assets around, but still kind of get to use them and keep them in all intents and purposes, still could be tax on that.
Yeah. And in that scenario, then, which is, I guess, the most common that I've seen with the gift with reservation, it falls back into the estate as if it was never even gifted.
Exactly, yeah.
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 So legally, and you know, there might be all sorts of reasons why perhaps that still makes sense. It might just make transferring the property and the kind of probate and everything slightly more practically a bit more easy. But it's not solving the tax problem people think it's solving.
No. I bet it's quite the surprise once everything's been looked at, that you might have
Definitely.
£1 million property that you thought was outside the estate that's just pulled back in.
Yeah.
Yeah. Yeah, I've seen that as well. And I think we were talking about another misconception, that only the rich really pay it. I think we were talking about that last time we were speaking.
Yeah, and I just think that's not the case with these changes in reliefs. The fact that 325k is the nil rate band, you know, when it first came in, you know, nobody had to worry really, unless you genuinely were quite wealthy.
Yeah.
But it's very easy for the family home to be worth more than that, which is why the 175 came in. But again, depending on where your house is and how long your family's owned it, it's still easy to be above that, especially if you're a business owner.
Yeah.
So it's definitely not only a problem for the rich, even though we talk about kind of big numbers, £2 million, that kind of thing. It is undoubtedly a big number, and anyone is successful if they are worried about numbers like that.
Yeah.
But it's not just for the super rich.
And with the other changes in legislation to bring pensions in,
yes,
you know, defined contribution pensions, that can make a huge difference. A lot of my clients have got, you know, high 6-7 figure pensions.
Yeah.
That was outside the estate previously, so we've not had to worry about that. And it was almost like, well, that's kind of legacy taken care of.
Yeah.
Everyone can have that, or the kids, or whoever can have that. But now it's just adding to the problem.
Yeah, well, we've had years of kind of encouragement to top these pensions up, and I would say it's not superannuation pensions. They're not going to be caught by those rules. But you know, you're encouraged to put money into your pension. It saves tax as you do it, but it's just an inheritance tax problem.
Yeah.
So, bit of a kick in the teeth.
It is a bit of a kick in the teeth. And and so yeah, I guess just to mention the defined contribution pension I mentioned there, that could be a SIP, you know, self-invested personal pension. It could be a personal pension. It's something that's not a defined benefit pension or a career average, as the NHS or parts of the NHS scheme are.
Yeah.
And so it's useful to make that distinction.
Definitely.
When we're talking about planning and how to plan for inheritance tax, you know, I guess I'll start on the point. For me, it's, well, how much do I need to live the rest of my life?
Yeah.
That's the kind of starting point. And how much do I need to be comfortable? Because, you know, it's one thing not paying any inheritance tax, but if that means you're not living the life you want, then, you know, kind of what's the point? So that's very much the starting point. But then once we've established that and we've got a figure and we kind of know what's surplus to requirements, what are the next steps for planning, in your opinion?
It's definitely a joined up thing between what you do as a financial planner and what I do as a tax advisor. So it is inheritance tax, but like I say, it definitely starts with what assets have you got? What assets do you need? What might be spare? But I suppose the first step is actually we can insure against it. That's your realm. You know, there's protection policies you can put in place to insure against potential inheritance tax liabilities, and the liabilities that might arise from gifting, which is kind of the main other part of it, is, well, actually, you've got to kind of start to give things away, put them in ownership of other members of the family, or perhaps in trust, or you know, start to shift that value to the people you want to benefit from it, rather than kind of stubbornly holding on to it and letting HMRC benefit from it one day instead.
Or not talking about it, which is what some families do. But I think you mentioned something really, really important there in terms of, you know, a lot of my clients are gifting away to the next generation. But a plan basically all plans are unique because all families are different. You've got different kids with different money maturities, different ages. You've got to factor in their spouses and whether you trust, you know, your kids' spouses or not, and all of these different things that kind of factor into what our options are in terms of planning. And that's, I guess, where we work together and say, okay, we've got a number of solutions, there's a number of routes, and there are a number of routes you can do it successfully if the ultimate game is reduce inheritance tax. But it's about making sure we kind of preserve wealth and we get the most use out of it from the people in the family. And I think that's where having a deep review of the circumstances is just really important. It's not just about that one number. It's about all of those other moving parts as well. And control as well, control of assets.
Yeah, definitely. So, I mean, like you say, everybody's solution will be different. Everybody's situation is different. But the solution starts in the same place for everyone. It's understand what you've got, understand what you need.
Yeah.
And then we can work together with other advisors as well. You know, if we end up talking about family investment companies, there might need to be legal advice involved in setting that up.
Yeah.
Same with trust and trust registration and all that kind of stuff, which might form part of some people's solutions. Once you know what you've got, once you know what you need, then we can start to build the plan unique to that person to see what should we do, what inheritance tax can we save.
Well, you touched on family investment company there, and it's becoming more and more popular, and you hear that term mentioned more and more.
Yeah.
Do you kind of just want to, I guess, expand on why it's becoming more popular and what its uses are?
Yeah, so family investment company, a lot of people will be familiar with what a limited company is. Lots of dentists operate through a limited company. We hear about them in life. But a family investment company is a company set up in a specific way with a specific purpose. And again, it's not an off-the-shelf kind of thing, but it might be, for example, a company that is owned by the children, by the next generation and below. So they are the shareholders, they own the company, but it's run still by the parents. So the parents are the directors. So the family assets might be, or some of the family assets might be held within the family investment company, or the FIC, as they're sometimes referred to. Parents keep control of it. It's actually one way around that kind of reservation of benefit thing, not for the family home, but in terms of the parents being in charge of what happens to other assets, like what cash might get invested into and things like that. Does it buy pot of rental properties? Is it in stocks and shares? The parents are deciding that. The parents are deciding how and when any profits or excess capital is distributed to the kids as well. So the parents keep control of when the kids get to spend the money.
Yeah.
But it's the kids' company. The value, the asset value, the bit that importantly is measured for when we're paying inheritance tax, that doesn't belong to the parents.
Yeah.
So it's outside of the parents' estate.
I guess that's where you mentioned roping in some other important professionals in, like a solicitor, where they draw the articles up to make sure that it stays within the family and those type of aspects.
Yes, things like, what if the kids have a failed marriage one day? Would we want the spouse remaining part of the company, or would we want to draft the articles of the company in such a way that can't happen? What about protecting the marriage of the parents? Not every marriage lasts forever.
Yeah.
It's important to think about what happens if we go our separate ways, because that's only ever going to cause problems. When do the kids actually start to become the directors of the company? When are we happy to actually give up that control as the parents and step back ourselves?
Yeah.
That's where, a good solicitor familiar with setting up family investment companies is worth their weight.
The other thing which is quite attractive is the devaluing of assets. If you say you've got £1 million in an investment company, family investment company, and you've got 2 kids and 2 parents, although the assets within the company might be £1 million, because the children or each shareholder has got 25%, you might think, well, the value's 250,000.
Yeah.
But because they might not have a controlling stake and the whole of the ownership, you can actually reduce that a little bit.
Yeah, it's called discounting. So a smaller slice of a company is worth less than its kind of headline percentage, I suppose.
And that's, I guess, an immediate advantage of setting it up.
Yeah.
Yeah. And
it's a really good one.
And to go back to the reason why, and from what I'm hearing a lot with my clients and our clients that we're dealing with, you mentioned they've had a limited company, they understand how it works. The flip side of that is the other thing's a trust, which is alien to most people.
It is. It's either seen, we were talking about this earlier, weren't we? I believe people either see a trust as something really scary and unknown, or a magic bullet. And I don't think it should be either, actually. It's perhaps because it's scary and unknown that people think it is the magic bullet, because it won't be. But it does have trusts do have their uses. For example, you could set up a family investment company that is planned to be owned by grandkids who aren't born yet, using a trust.
Yeah.
You wouldn't be able to do that without a trust, because something needs to own those shares. And until the grandkids or the great-grandkids exist, can't do that. Well, the only thing I was going to say, you could also use a trust alongside a family investment company. So you've got two different strategies running where maybe you're gifting cash into the trust. One of the things to watch out for, they have different tax rules.
Yeah.
So gifting into trust can cause lifetime inheritance tax in certain circumstances, and it starts kind of clocks counting for 7-year gifts and tapering of the inheritance tax and stuff, where that can be avoided with a family investment company.
Yeah.
But putting assets into a family investment company might cause other taxes along the way. So it kind of comes back to different solutions for different circumstances. There's no one-size-fits-all answer.
Yeah. And it just shows that you need to get the right people in the room for making these decisions.
Yeah.
Because most of them are long-lasting decisions, and once you've been made, they're quite hard to unravel.
Yeah.
I guess as well, it kind of touches on, and we always talk about forward planning and how it's important. And if we're thinking about kids that aren't even born yet and maybe their generation, which is what is really important to a lot of our clients, it kind of just shows you the extent of how deep we're digging about the actual goal of preserving the family wealth.
I think that's our end goal for all of what we're doing, isn't it? Whether it's inheritance tax and the future of the family, or whether it's a bit more in the here and now, because that's also relevant. What's next year's tax going to be?
Yeah.
It's all kind of part of it. I would say everyone should be thinking about this now.
Yeah.
And it's never too early to be thinking about this. It's a morbid topic. I get it.
Yeah.
No one wants to think about paying inheritance tax because it means you've died.
Yeah.
Most of the time, and no one really wants to think about that. But it is going to happen to all of us, and we can do nothing and let what will happen, or we can do something and maybe not even solve all of it, because maybe it's actually never all going to go away. But some of it could go away if you're thinking about it and actively planning it.
Yeah, and I think in terms of at least knowing the starting point and knowing what your inheritance tax position is, that is really important as well, because most people I speak to don't. And it's interesting you say, some people don't want to have those conversations. And I've got a real mix of clients. I've got some clients that they actively talk about it, and they have done since the child was been in their 20s, now in their 40s. And it's in their family culture that it's actually a really important thing we talk about. I've got other clients that they kind of won't even have that conversation. And then that's the stage where I'm showing them that pie chart of the HMRC's beneficiary and saying, okay, we need to do something about this. And that's where I think that a lot of the complication for, our clients as well is knowing who to speak to, which is why working with a team of people that work closely together and are happy to refer them to other people when it's not their wheelhouse is so important. And it's confusing as well, because there's some trusts that I'll deal with, for example, settling some investment bonds in trust and doing that type of work, which you wouldn't. Yeah. And there's some stuff with trust work that you would do that I just wouldn't, for example, advising property and trust and stuff like that, which we'd also need to pull a solicitor in.
Yeah, well, also on the insurance side of it, like we legally can't do it all. I cannot sell someone an insurance policy against the tax on inheritance tax. That needs you.
Yeah.
That's your domain, and a perfectly valid strategy for inheritance tax. I'll just make sure there's enough life insurance to pay it.
Well, that's it. And it works for some people. We can structure the life insurance, and some people just say, I'm just not comfortable giving up control.
Yeah.
Because the worst case scenario is, or one of the really bad scenarios is, you give a lot of money to your kid and they waste it. It's bad for you, it's bad for them. They obviously feel bad about it. But it's just making sure we don't put them in a position where they could lead to a big mistake or something which is going to, they're maybe not ready for, mature enough for. So again, it goes back to that joined up thinking, and why, in my view, you need people that are all on the same level of expertise and forward thinking, but can do different aspects of the job.
Yeah, absolutely.
Yeah. So in terms of strategies, is there anything you think that we've not really touched on? We've got family investment companies, we've talked about trusts, we've talked about gifting. I guess just direct gifting is another way that you can do that.
You can just gift assets away. Again, there's the 7-year clock. So if you gift an asset away and then sadly pass within the next 7 years, there can still be inheritance tax. But that resets every 7 years. So what some people will do is gift away up to their allowances every 7 years in a cycle. There's other kind of little gifts you can give. kind of designed to mean that when you're buying your kids a Christmas present, there's not inheritance tax to worry about or whatever. But that, you know, there's other gifts you can do. Something that's often overlooked is the regular gifts from income.
Yeah.
So if you're kind of quite wealthy, or maybe not even quite wealthy, but if you've got excess income, you could be making regular gifts to start to give away what you don't need every month, as long as it's regular, as long as it's from your income, not depleting your capital reserves, and as long as you're maintaining your quality of life, you can give away anything without worrying about inheritance tax if those three markers can be shown to be being hit.
And that's outside the estate immediately?
That's outside of the estate immediately, yeah. We don't have to worry about it using up any reliefs, any allowances, any 7-year clocks, anything like that. So it could be useful with school fees, for example.
It's often overlooked. Yeah. And again, you know, if you're in your 60s and you live till 90 and you're doing that, it makes a big effort. Obviously, you're helping the next generation as well.
Yeah.
But also you're reducing your estate with money you don't really need.
Yeah.
Because I've seen clients that have, you know, they've got parents in their 90s and they've just been accumulating cash, with, let's say, 20 grand a year they could have been giving away. And I think it's really important to document it as well.
Definitely.
In terms of when you are doing that. Just because I've had a case recently where a client had been doing it, but it wasn't documented, and I came to them after their parents had passed away, and I was kind of dealing with the client's inheritance, and they'd not documented these gifts properly, which meant the solicitors had to investigate and speak to the banks, and that actually racked up a lot of solicitor fees.
Yeah.
So it kind of undid a lot of that hard work. So there is a HMRC form you can use.
Yeah, there is.
Which is really useful, and again, it just means that everything's in order. And you've kind of documented everything.
Yeah, definitely. One thing we find a lot is people coming to us kind of with their own parents being wealthy, and they're not necessarily thinking about their own inheritance tax situation, they're thinking about their parents.
Yeah.
So that can be kind of awkward when we're saying, well, look, we need to talk with your parents, and actually we might be starting to suggest they give you some stuff.
Yeah.
So you might feel like you're being a bit greedy about this, but like you don't want I really don't want HMRC to get your parents' wealth.
Yeah.
I want you to get it.
Yeah, of course.
Clients to get it, of course.
And it goes back to the informed decisions, which we always come back to, which is if you know your inheritance tax bill is going to be £1 million and you're happy with that, then that's fine. That's the strategy.
Yeah.
But at least we know and we're making the decision based on the facts instead of kind of going in blindly.
Yeah.
I guess the other strategy as well is you could spend it.
Yeah, spending it is perfectly valid, and some people do just that.
Yeah.
Why not? You know, you've worked hard to be in a situation where you've got stuff to spend. Go and spend it.
Yeah.
What I would say is to anyone watching this who doesn't know inheritance tax situation, do get in touch.
Yeah.
You know, we can go back to those first kind of 2 points we made about knowing what you've got and knowing what you need.
Yeah.
Between you and I, we can enlighten people on that and show them their possible inheritance tax liability and start to discuss solutions.
Yeah, I think we're going to happy to do a consultation to go through existing inheritance tax position, like you mentioned, Simon, and also options.
Yeah.
I guess at least to start a conversation.
Yeah.
And I can assure you that you'll get some value from that meeting.
Yeah.
And whether it's just an idea, I didn't know if we could do that. My parents can start gifting out of income for school fees or university fees or whatever it is, or even I've done it with gifting into some grandchildren's pensions, things like that. Mm-hmm. So yeah, it's just about understanding where you are now and where you're trying to get to and what your options are. And I think that's very much the starting point for a lot of people, isn't it?
Definitely.
Okay, thanks for going through that, Simon. That was really useful. I think touched on a few different aspects there, but very much get in touch for an understanding. And the actual, not the advice, but the kind of end of the meeting might just be, well, actually, I think you might need to speak to a solicitor.
Yeah.
Get your will sorted as a very baseline.
We didn't talk much about that.
But I think just booking a consultation with either Simon or myself, and we'll go through your inheritance tax position and see if there's any way we can help. But yeah, thanks for joining me and going through that, Simon.
Thank you, David.
Cheers.